We're going to look at WIPRO Limited. This is an Indian IT and consulting company. And I'm going to be looking at the ticker trading on the Indian Stock Exchange. It's called the NSE, the National Stock Exchange of India. All the numbers in this video are going to be in Indian rupees. And the reason I do this is because the company reports all its financials in rupees. This company does trade on the New York Stock Exchange under the ticker WIT. So let's get started with the model. This company has a market cap of 1.546 trillion rupees. And next we need the stock price. And they're trading at 270.55. And next we're going to pull the free cash flows. And this is the cash that's remaining after operating your business, minus capital expenditures. And the way you value a company is you estimate the future free cash flows and then discount that number back to today's value. And that's what I'm doing in this video. Now I'm pulling the net income. That's on the income statement. That's a profit and loss for the company. Next we're going to pull the revenue, which is also on the income statement. That's the sales for each year. The numbers appear pretty consistent from year to year, so we should get a good value for the model. Let's look at the capital structure of the company so we know what discount rate to apply to the future cash flows. They pay 5.1 billion of interest on their debt. Let's go to the balance sheet to see how much debt they have. Current debt of 73 billion. That's debt due within 12 months. Long-term debt of 4.8 billion. That's debt due after 12 months. Most of the debt is due within 12 months, which is not the best sign. So they have to roll the debt or pay it off. Since interest payments are tax deductible, let's get their effective tax rate. We'll go back to the income statement. And the income before tax is 122 billion. And the income tax is 24 billion. So the effective tax rate is 20%. The cost of debt is 5.25%. To get the cost of equity, we need the beta. That's how volatile the stock is relative to the market. And they have a really low beta, 0.37. So it's a pretty safe stock to invest in. Doesn't move too much. Let's get the current assets. We need the current assets to calculate the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. This is what the company uses to run its day-to-day operations. And next we need the current liabilities. And the equity is the value of the company according to the balance sheet. That's assets minus liabilities. That's 557 billion. Now we need the operating income, which is on the income statement. That's 103 billion. Let's look at the capital structure. The cost of debt is 5.3% and they have 12% debt. The cost of equity is 5.2% and they have 88% equity. So the weighted average cost of capital is 5.2%. That's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. That's 2.3 trillion. We discounted those numbers back to today's using the weighted average cost of capital. We get a value of the company of 2.1 trillion rupees. We divide that by 5.7 billion shares. We get an intrinsic stock price of 365. It's trading at 271, so it's trading at a 26% discount. So it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're much lower. They're saying it's worth $128. So you can see in my model, I used a pretty conservative model. The estimates aren't that high and they're actually lower than the past numbers. From doing some research on the company, it didn't seem like their future growth was going to be that strong. So I used a pretty safe model and I still came up with a value that's above their stock price. And it's interesting to see that Simply Wall Street's below their stock price. Let's see where the stock has been trading. It looks like it peaked about 280 a few months back, and then it dropped to maybe 180, but it's come back up since coronavirus. It seems like it's on an uphill climb since coronavirus, which is the opposite of most stocks. Let's look at the financial ratios. They have a decent PE, 15.9. I like to see below 15. That's price of stock over earnings per share. To get earnings per share, that's net income over shares outstanding. Their price of sales is 2.5, which is good. That's price of stock over sales per share. To get sales per share, it's revenue over shares outstanding. They have a good price to book of 2.8. That's price of stock over book value per share. And to get book value per share, it's equity over shares outstanding. They have a good current ratio of 2.4. That's current assets, 520 billion, over current liabilities of 216 billion. ROE is decent, 17%. That's net income, 97 billion over equity, 560 billion. They can cover their interest payments 20 times. That's EBIT over interest expense. That's good. And debt of 12%. So the best way to look at ratios is to compare them to similar companies. I've done videos on Accenture, FleetCor, IBM, and Science Applications. This is WIPRO right here. And if their numbers in green, they're better than the average in the industry. If they're in red, they're worse than the average. So for PE, they're better than the average at 15.9. Average is 19.5. IBM is the best. For price of sales, they're also better than the average at 2.5. Average is 3.2. Better than the average of price to book at 2.8 versus 5.2. They're actually the best in price to book of the companies. They have the highest current ratio of the companies. But they are lower than the average in ROE, debt, and market cap. Ratios look pretty good. It seems like it has a lot of growth potential. Not quite sure why Simply Wall Street has the value so low. Leave a comment. Thanks for watching.